Global debt has reached the highest level in recorded history. At the same time, economic growth is slowing and job markets are beginning to lose strength. This is how many past crises started. But today, the risks are structured very differently from 2008. In this video, we examine what the global economy actually looks like beneath the headlines. Using verified data from institutions like the IMF, OECD, World Bank, and the International Institute of Finance, we'll break down rising debt, slowing growth, and early warning signals inside labor markets. This is not a prediction of an inevitable crash. Instead, it's an explanation of what the numbers are telling us and what they are not. By comparing today's conditions with previous economic crises, we can see where the similarities end and where new risks begin. By the end of this video, you'll understand whether the global economy is experiencing a normal slowdown, or whether history suggests that a major downturn around 2026 is becoming increasingly likely. Let's begin with the most important number in the global economy today: total debt. According to data from the International Institute of Finance, global debt reached about $337.7 trillion by mid-2025. This is the highest level ever recorded in human history. This number includes government debt, corporate debt, and household borrowing combined. To understand how fast this grew, we need to look back just 10 years. In 2015, total global debt was around $213 trillion. By 2024, it had already crossed $318 trillion, and it continued rising into 2025. That is an increase of roughly 50% in one decade. Now here's the key problem. During the same period, the global economy did not grow at the same speed. Global GDP increased, but much more slowly than debt. This means the world is borrowing faster than it is producing income. When debt grows faster than economic output, it creates pressure. Governments struggle with interest costs. Companies depend more on cheap credit. Households become sensitive to job losses and inflation. High debt alone does not cause a crisis, but history shows that record debt levels make the global system fragile. When a shock hits, higher interest rates, slower growth, or financial stress, highly indebted economies have far less room to recover. To understand why today's debt levels are so dangerous, we need to compare debt with economic output. This is where the debt-to-GDP ratio matters. Right now, total global debt stands at more than 235% of global GDP. In simple terms, this means the world owes more than 2 times what it produces in a year. This level of imbalance is extremely rare outside of major wars or global emergencies. According to international financial data, total global debt can be broken into 2 major parts. Public debt, which is money borrowed by governments, stands at roughly $99.2 trillion. Private debt, which includes corporations and households, is around $151.8 trillion. Together, that is more than $251 trillion. And this does not even include all financial sector liabilities. The key issue is not just how large these numbers are, but who holds the debt. In many past economic cycles, either governments were highly indebted or private companies were overleveraged, but not both at the same time. Today is different. Governments are carrying record high deficits. Corporations are dependent on cheap credit to survive. And households in many countries are stretched by mortgages, credit cards, and rising living costs. This creates a system where everyone is exposed at once. When interest rates rise or growth slows, governments face higher borrowing costs, companies cut investment and jobs, and consumers pull back spending. History shows that economies can handle high debt, but only when growth is strong. And when growth slows and debt remains high, the system becomes fragile. That is why today's debt-to-GDP levels are one of the most important warning signals in the global economy. Now let's look at where most of the world's government debt is concentrated. When we break the numbers down by country, the scale becomes much clearer. In 2025, the United States had the largest government debt in the world, at around $38 trillion. This equals roughly 125% of US GDP, meaning the government owes significantly more than the country produces in one year. China comes next, with government debt of about $18.7 trillion, or roughly 96% of its GDP. While China's ratio is lower than the US, its debt has grown rapidly over the last decade as growth has slowed and stimulus spending increased. Japan remains the most extreme case. Its government debt stands at approximately $9.8 trillion, which is around 230% of GDP, one of the highest debt ratios ever recorded in a major economy. Japan has avoided a crisis so far, but only under very specific conditions that do not easily apply to other countries. In the United Kingdom, government debt is about $4.1 trillion, equal to roughly 103% of GDP. This reflects years of borrowing following the global financial crisis, Brexit-related shocks, and the pandemic. What matters most is concentration. The United States and China together account for more than half of all government debt worldwide. This means that any financial stress in either country does not stay local. It quickly becomes a global problem. When the largest economies carry the largest debts, the entire global system becomes more sensitive to shocks. Debt alone does not cause an economic crisis. What really matters is how fast the economy is growing compared to how fast debt is rising. This is where global growth trends become critical. If we look at global GDP growth since 2019, we see a clear slowdown. After the sharp rebound following the pandemic, growth has steadily weakened. According to projections from the OECD, global GDP growth is expected to be around 3.1% in 2025 and slow further to about 3.0% in 2026. At first glance, these numbers may not look alarming. 3% growth sounds stable. But the problem is context. Global debt has been rising much faster than global output. When borrowing grows quickly and economic growth slows, the system becomes increasingly fragile. The World Bank has also issued warnings. It stated that global growth in 2025 is expected to be the slowest since 2008, excluding periods of full recession. Several factors are driving this slowdown. Global trade has weakened, higher interest rates have tightened financial conditions, and rising trade barriers and tariffs are putting pressure on investment and productivity. Slower growth means governments collect less tax revenue, companies earn less profit, and households face weaker income growth. At the same time, high debt means interest payments keep rising. This combination, slow growth and high debt, is one of the most dangerous patterns in economic history. It does not usually lead to an immediate crash. Instead, it creates a long period of vulnerability where even a small shock can trigger much larger problems. That is why today's global growth trend is not just a statistic. It is a warning signal. So why does all of this really matter? Because when debt grows faster than GDP, economies become increasingly vulnerable. Simply put, it becomes harder to earn enough money to service and repay that debt. Right now, the world is not officially in a recession. Many economies are still growing, and markets often appear calm on the surface. But underneath, the gap between rising debt and slowing growth is widening. This is not a short-term problem. It is a structural risk built into the global system. High debt means higher interest payments. When growth slows, governments collect less tax revenue, businesses see weaker demand, and households struggle with rising living costs. This leaves very little room to absorb shocks. In past cycles, strong growth helped economies grow out of debt. Today, growth is weaker, productivity is slowing, and borrowing costs are higher than they were for much of the last decade. This combination does not guarantee a crisis tomorrow. But history shows that when debt stays high and growth stays low for too long, the system becomes fragile. And fragile systems break easily when pressure increases. One of the most important warning signals in any economy is the labor market. Jobs usually weaken before a recession becomes visible in official data. And right now, the U.S. job market is showing signs of quiet stress. In December 2025, the United States added only 50,000 new jobs. This was the weakest monthly job gain since the pandemic period. For an economy the size of the U.S., this number is very low and suggests that businesses are slowing down hiring plans. At the same time, the official unemployment rate fell slightly to 4.4%. On the surface, this looks positive, but this is where it becomes misleading. Unemployment can fall even when job growth is weak, especially if fewer people are actively looking for work or if companies reduce hours instead of laying workers off. What matters is momentum. Over the past year, job creation has clearly slowed. Many companies are choosing caution. They are delaying expansion, cutting costs, and avoiding long-term commitments. This behavior is typical during periods of economic uncertainty. Businesses sense weaker demand ahead before consumers do. Instead of mass layoffs, they first slow hiring. The U.S. labor market is not collapsing, but it is cooling from the inside. And historically, when job growth weakens while debt remains high and growth slows, it often signals that the economy is entering a more fragile phase. The same warning signs are not limited to the United States. Across Europe and the United Kingdom, labor markets are also beginning to weaken. In the United Kingdom, job vacancies have fallen by about 44% by early 2026 compared to their recent peak. This sharp decline shows that companies are posting far fewer new jobs than they were just a year earlier. At the same time, UK unemployment has risen to around 5.1%, the highest level in 5 years. These numbers matter because vacancies usually fall before unemployment rises. Employers stop hiring first. Layoffs often come later if conditions continue to worsen. This pattern has appeared repeatedly before past economic slowdowns. Similar trends can be seen across parts of Europe. Businesses are facing weak demand. Borrowing costs are higher, and uncertainty around trade and energy prices remains elevated. As a result, companies are becoming more cautious about expanding their workforce. This does not mean Europe or the UK is already in a recession, but it does show that labor markets in major developed economies are losing strength. Historically, when employment weakens at the same time that growth slows and debt remains high, it is a classic early warning signal. It suggests the global economy is moving into a more fragile phase. To understand why today's economic risks look different, we need to compare the current situation with the period before the 2008 global financial crisis. History does not repeat exactly, but it often rhymes. Before 2008, global debt levels were high, but they were much lower than they are today. In 2007, total global debt was roughly 200% of global GDP. Growth was also stronger. Many economies were expanding at faster rates, and interest rates were lower, giving governments and central banks more tools to respond when the crisis hit. Today, the picture has changed. Global debt now stands at over 235% of global GDP, significantly higher than before the 2008 crisis. At the same time, global economic growth has slowed. Productivity growth is weaker. Populations are aging in many countries, and trade growth has cooled. Another key difference is who holds the debt. In 2008, the main problem was concentrated in the financial system and the housing market. Governments entered the crisis with relatively healthier balance sheets. Today, governments themselves are heavily indebted, along with companies and households. This means the global economy is less resilient to shocks. When debt is lower and growth is stronger, economies can absorb crises more easily. When debt is high and growth is weak, even small disruptions, higher interest rates, banking stress, or geopolitical shocks can have much larger effects. The risk today is not a repeat of 2008. The risk is a different type of crisis. It is driven by high debt that slowly limits growth and increases instability across the global system. So what does the future look like if current trends continue? This is where warnings from the International Monetary Fund, or IMF, become important. According to the IMF, global public debt is no longer moving down after the pandemic. Instead, it is rising again. The IMF projects that global public debt could reach nearly 100% of global GDP by 2030. This would reverse the earlier declines seen after emergency pandemic spending ended. Even more concerning is the IMF's severe scenario. If growth slows further, interest rates remain high, or governments face new shocks, global public debt could rise to around 117% of GDP as early as 2027. This would be the highest level since World War II. These projections matter because they assume no major crisis has yet occurred. They are based on current policies continuing, not on a global crash. In other words, debt is expected to rise even without a recession. The IMF also warns that high debt limits governments' ability to respond to future shocks. When debt is already high, governments have less room to spend during downturns without risking financial instability or loss of confidence. This creates a dangerous cycle. Slower growth raises debt levels. Higher debt makes growth harder to achieve. And when a shock finally arrives, whether financial, geopolitical, or economic, the system has fewer defenses left. The IMF is not predicting a guaranteed collapse, but it is clearly warning that the global economy is moving into a period where mistakes become more costly, and resilience is much weaker than in the past. Based on current data and historical patterns, there are three main ways the global economy could move toward 2026. None of these outcomes is guaranteed, but each is realistic given today's conditions. Scenario 1 is a soft landing. In this case, global growth continues at a modest pace. Inflation slowly comes down, allowing central banks to reduce interest rates without triggering new price pressures. Governments manage debt carefully, and financial markets remain stable. This is the most optimistic outcome. However, even in a soft landing, growth would likely remain slower than in the past decade, and debt levels would stay high. The system would survive, but it would remain fragile. Scenario 2 is stagnation. This is a more likely outcome according to many economists. Growth stays low for years, while debt servicing costs remain high. Governments face rising interest payments. Companies cut investment, and households struggle with weak income growth. Living standards slowly decline, even without a dramatic crash. This kind of environment does not feel like a crisis, but it quietly erodes economic stability over time. Scenario 3 is a crisis trigger. In this scenario, the global economy is already weak when a sudden shock hits. This shock could come from banking stress, a major geopolitical conflict, a sharp rise in energy prices, or a credit market freeze. Because debt levels are already high and growth is low, the economy has little ability to absorb the shock. What would normally be manageable becomes severe, pushing the system into recession or financial crisis. History shows that major downturns often start with unexpected triggers, not obvious ones. The question for 2026 is not whether risks exist. They clearly do. The real question is whether the global economy can avoid a shock long enough to stabilize. So where does all of this leave us? Based on the data, the world is not in a recession right now. Many economies are still growing, and financial markets are not in crisis mode. But the numbers also show something important. The global economy is becoming more vulnerable. Debt levels are at historic highs. Economic growth is slowing, and labor markets in major economies are losing momentum. Taken together, these signals do not point to an immediate collapse, but they do point to rising risk beneath the surface. History offers a clear lesson. Debt-driven slowdowns rarely end quietly. They usually lead to major corrections, whether through inflation, long periods of stagnation, financial stress, or outright crises. The timing is never predictable, but the direction often is. What makes the current situation unique is that governments, companies, and households are all highly indebted at the same time. This reduces the system's ability to absorb shocks when something unexpected happens. A financial shock, a geopolitical conflict, or a sudden slowdown. The impact can spread much faster. Whether 2026 becomes a year of resilience or a year of crisis depends on factors we cannot fully control or predict. But the warning signs are already visible in the data. Understanding them does not mean fearing the future. It means being prepared for it. If you want deep dives into economic history backed by real data, not hype and headlines, subscribe to Econemy Historian and turn on notifications. This channel breaks down the biggest global economic trends using facts, context, and history. I don't tell you what to panic about. I show you what the numbers actually mean, so you can understand the economy before the headlines do.